Imagine watching nearly $100 just vanish from the price of an ounce of gold, like in the time it takes you to drink your morning coffee.
Yeah, just gone, completely wiped out.
Right. I mean, no gradual dip, no early warning indicators flashing, just a trapdoor opening underneath the entire precious metals market. So today, we are dissecting the June 23rd bloodbath. Welcome to today's deep dive.
It's a rough one today, folks.
It really is. And if you are staring at your portfolio right now, trying to figure out what on earth just happened and, well, how to protect your assets, do us a quick favor first. Hit that like button, subscribe to our channel, and drop your initial thoughts in the comments. We really want to know how you're weathering this storm.
Because it is a storm. I mean, it caught a massive portion of the retail market completely flat-footed.
Oh, absolutely. Which is exactly why we have a very specific mission for you today. We are going to make sense of this sudden $100 plunge in gold. We're pulling back the curtain on the hidden macroeconomic forces that are just pulling money out of the market.
Right, because it doesn't happen in a vacuum.
Exactly. And most importantly, we are going to look at the exact strategies the data points us toward. That way, you know how to navigate this extreme volatility without, making a critical error. To help cut through all this panic, I'm joined by our senior market analyst. And I know you have a very strict philosophy for days where the screen is just, well, a wall of red.
I do, yeah. And look, the philosophy is simple, and it has to be your anchor right now. In moments of extreme market pressure, you must rely entirely on data and strategy, not emotion.
Easier said than done, right?
Oh, for sure. I mean, when you see a vertical drop on a chart, the human instinct is to panic sell or aggressively buy the dip. But both of those emotional reactions can absolutely destroy your capital. We have to look at the mechanics of the drop first.
Data over emotion. I really love that. So let's look at the timeline, because a drop of this magnitude, it doesn't just happen because traders woke up in a bad mood.
No, not at all.
There has to be a catalyst. So walk us through the sheer momentum of what happened today, because the speed of it is just staggering.
It is. Let's trace the tape here. From midnight last night, straight through the dawn hours, gold was actually behaving incredibly normally. I mean, it was hovering calmly right around $4,200 per ounce.
Just a standard overnight session.
Exactly. To the average observer, it looked like a totally stable, boring overnight session. Yeah. Nothing to write home about.
But then the clock strikes 5 in the morning. New York starts waking up. The European markets are in full swing. And someone hits the emergency stop button.
Yeah. That is when the intense, unrelenting selling pressure began. And I mean unrelenting. By 12 noon, the price had plummeted down to $4,092 an ounce.
Man, that is nearly a $100 wipeout in just a matter of hours. And to visualize what is happening behind the scenes there, it is not just, people deciding to sell, it's a cascade.
A total cascade, yes.
Because once the price drops past a certain point, it triggers those automated stop-loss orders, and then those trigger more sales, which trigger more stop-losses. It's just a massive domino effect.
That is the exact mechanism. You have institutional algorithms and, frankly, frightened retail traders all sprinting for the same narrow exit door at the exact same moment.
And the door isn't big enough.
Right. The volume of sell orders completely overwhelms the buyers, and the floor simply gives way.
Wow. And if we look at the broader precious metals sector, gold wasn't even the canary in the coal mine here. Silver actually started ringing the fire alarm a full 12 hours earlier.
Yes, silver led the entire market downward, and violently so. I mean, starting at 5 o'clock yesterday evening, silver was sitting at $66.08 per ounce.
Okay.
By 5 o'clock this evening, it had collapsed down to $62 flat. That is a drop of nearly $5.
$5. In percentage terms, a $5 drop for silver is catastrophic for anyone holding highly leveraged short-term positions.
I know it wipes them out.
And just to zoom out for you to see the whole board, platinum fell about 3% today. Palladium dropped nearly a few percent. So we aren't just talking about a gold phenomenon here. This is a systemic retreat from the entire precious metal sector.
Money is being vacuumed out of the metal space entirely. It's just flowing out.
Which brings us to the evening state of the market. As we are sitting here recording this deep dive, the massive sell-off has paused.
For now.
Right, for now. The market is currently consolidating, locked in this tense tug of war between $4,110 and $4,130. Now, I have to ask on behalf of everyone listening who just wants the bleeding to stop, is this evening's pause proof that we have finally hit rock bottom? Like, is it safe to go back in the water?
I cannot stress this enough. You need to treat this pause with extreme caution. This evening's consolidation is absolutely not a confirmed bottom.
So it's just a breather.
Exactly. It is simply the market catching its breath. The initial panic sellers are out, but the buyers haven't stepped back in with any real conviction yet. That $4,100 mark for gold is highly sensitive.
I like to think of it like a sheet of ice over a frozen lake. It's holding your weight for now, but if another heavy wave of selling jumps on it, it could crack wide open.
That is a perfect way to look at it. If that ice breaks, the selling resumes instantly. And for silver, that $62 mark is the critical support floor.
And if it loses that,
losing $62 could trigger an even wider, more aggressive plunge because there simply aren't enough buyers waiting just beneath that price to catch the fall.
Okay, so the mandate for you listening is crystal clear. Do not let your guard down just because the screens start flashing red for an hour. So let's unpack the macro forces here because, as we said, a $100 drop doesn't happen in a vacuum. Where is all this money fleeing to and why?
Well, the primary force crushing precious metals today is the United States dollar. The U.S. dollar index has surged past 101.3 points.
Wow.
Yeah, and to put that in context, that is its highest level in over a year.
Let's break down the mechanics of that for a second. Why does a strong dollar hurt gold?
Well, because gold is priced in U.S. dollars globally, right?
Correct.
So if you are a massive jewelry manufacturer in India or, say, a tech company in Japan needing silver, you have to exchange your local currency for dollars to buy those metals.
Right. And when the dollar is suddenly sitting at a one-year high, your local currency buys fewer dollars. Suddenly, gold is wildly expensive for you, even if the actual price of gold hasn't moved an inch.
Oh, I see. So global demand physically shrinks.
Exactly. International buyers are just forced to step away from the table. It's too expensive.
That makes practical sense. The dollar is pricing global buyers out of the market. But, it's not just the currency, is it? We have to talk about the bond market.
We absolutely do. The yields are staggering right now. Yeah, 10-year United States Treasury yields are hovering near 4.5%, and 2-year yields are sitting over 5%. Now, I want to push back on this a bit.
Sure.
Put yourself in the shoes of a regular person listening to this right now. If I am holding physical gold coins in a safe, to protect my family's wealth against inflation, why do I care what a 2-year government bond is doing? Explain this whole opportunity cost thing to me like we're sitting at a kitchen table looking at our savings.
Okay, let's look at it exactly from that kitchen table perspective. Imagine you have, say, $10,000 in cash. You want to protect it. Choice A is buying physical gold.
Okay.
Gold is fantastic insurance against long-term currency collapse.
Yeah.
But that gold coin just sits in your safe. It does not pay you a monthly dividend. It doesn't send you an interest check. In financial terms, it is a non-yielding asset.
Right. My gold coins aren't out there working a night shift to bring me more money. They just sit there.
Exactly. But look at choice B. You take that same $10,000 and you lend it to the United States government by buying a 2-year Treasury bond. Right now, because of the Federal Reserve's policies, that bond guarantees you a yield of over 5%.
Guaranteed?
Yes, that is a guaranteed return backed by the government with essentially zero risk of default.
Okay, so from a purely mathematical standpoint, I'm looking at a gold bar paying me 0% versus a bond handing me 5% guaranteed every single year.
And the difference between those two choices, that is your opportunity cost. When bond yields get this incredibly high, massive institutional money gets lazy, why take on the risk of the volatile gold market when the government is handing you 5% risk-free?
Wow, yeah, that makes a lot of sense.
So hundreds of millions of dollars flee non-yielding assets like gold and rush into the bond market to lock in those safe returns. The entire market is betting that the Federal Reserve will maintain this high interest rate policy.
Okay, so the competition for capital is ruthless, and right now, 5% guaranteed is just winning. But that brings us to a massive contradiction, I think. Because gold is supposed to be the ultimate safe haven, right?
Historically, yes.
When the world gets chaotic, money hides in gold. And let's be honest, the geopolitical landscape right now is an absolute powder keg. Why isn't the ongoing global instability propping up the price of gold against this strong dollar?
It all comes down to the geopolitical pivot we have seen over the last few days. You are correct that gold thrives on chaos. But you have to remember, financial markets are incredibly cold and forward-looking. Right now, they are seeing signals of easing tensions in key global choke points.
You are talking about the Middle East, specifically the United States and Iran, right?
Yes. Following initial diplomatic talks in Switzerland, the United States has temporarily eased some Iran-related sanctions for a period of 60 days.
Wait, hold on. 60 days?
Yeah, 60.
That is absolutely nothing in the grand scheme of global geopolitics. That is a Band-Aid that falls off in 2 months. Why on earth is the market dropping gold prices over a temporary 2-month pause?
Because you are thinking like a historian, and the market thinks in milliseconds.
Okay, fair point.
Traders do not care about what happens in year 3 of a conflict. They care about the momentum of tomorrow. We have to look at something called the geopolitical risk premium.
Let's define that for the listeners. The geopolitical risk premium. What exactly is that?
Think of it as a fear tax. For months, gold and oil have been trading significantly higher than their actual fundamental economic value.
Because of the fear.
Right. Buyers were happily paying a massive premium, this fear tax, because they believed a massive regional war could break out at any second and completely disrupt global supply chains.
But once diplomats sit down at a table, even if it's just for a 60-day Band-Aid, that immediate threat level downgrades.
Exactly. The fear tax instantly deflates. The algorithms and the traders, they look at the news, realize the immediate threat of war is off the table for the next 2 months, and they instantly dump the premium they were paying.
Which is why we're seeing oil prices actively falling right now alongside gold.
They move in tandem on this issue. Now look, there are still military actions happening in Lebanon. Transport ships are still exercising extreme caution navigating through the Strait of Hormuz. The tension is absolutely still there.
Sure.
But in the cold, calculating eyes of the market, it is no longer hot enough to justify paying a premium for gold today.
Wow. So the safe haven buyers take a step back, the fear tax vanishes, and those massive 5% treasury yields basically take the steering wheel and drive the price down.
That's the perfect summary.
It makes complete sense for these short-term retail traders. But what about the whales? What are the massive financial institutions doing while all the retail traders are panic selling?
Well, this is where the story completely flips on its head. If you look at the exchange-traded funds, the ETFs, which represent the truly massive institutional money, they are doing the exact opposite of the retail crowd.
Interesting. Let's look at the data for the SPDR Gold Shares Fund, which is one of the heaviest hitters in the ETF space.
Yeah, the SPDR Gold Shares Fund bought over 7 tons of physical gold late last week.
7 tons.
And as the price began to shake and drop early this week, they stepped in and bought over 1 ton more.
Over 8 tons of physical gold accumulated while the price is dropping. It is like watching panicked passengers jumping off a cruise ship in a storm into lifeboats, completely unaware that below deck, the captain is quietly loading the cargo hold with treasure because he knows the ship is entirely fundamentally sound.
That is exactly what's happening.
Yeah.
The institutional whales are not panic selling. They're using this drop as a massive discount window to accumulate. However, we have to look at the volume. While the big funds aren't selling, their current buying volume isn't strong enough to spark a massive bull run on its own today.
Even with central banks around the world buying gold at a historic pace.
Central bank buying provides a floor, sure, but it is slow, methodical, and opaque. It is a slow drip. It is not a fire hose of liquidity.
I see.
Central bank buying is not enough to replace heavy ETF retail demand in the short term. The institutional buying is preventing a total collapse, but it cannot single-handedly drive the price back up right now.
So the whales are buying the dip, but they aren't buying aggressively enough to stop the bleeding, which means the market is in a holding pattern just waiting for a catalyst. And that brings us to what I consider the final boss of the financial week.
You're referring to the personal consumption expenditures data.
The PCE report, exactly. For anyone who doesn't spend their week refreshing economic calendars, explain why this specific report has the entire gold market holding its breath right now.
The personal consumption expenditures report is the Federal Reserve's absolute preferred measure of inflation. It dictates every single move they make regarding those interest rates we talked about earlier.
And why do they prefer it over the Consumer Price Index, the CPI? Because that's the one we always hear about on the evening news, right?
Right, the CPI. So the difference really comes down to the substitution effect.
The substitution effect.
Yeah. So the Consumer Price Index assumes you buy the exact same basket of goods every single month. If beef gets ridiculously expensive, the CPI just measures the higher cost of beef.
Okay.
But the Personal Consumption Expenditures Index, it tracks what consumers actually do. If beef gets too expensive, you substitute it. You buy chicken instead.
Ah, okay.
The PCE captures that behavior. giving the Federal Reserve a much more realistic nuts and bolts view of how inflation is actually hitting the consumer.
So it's the truest read of inflation. Let's map out the fork in the road for this data release then. What are the scenarios?
Scenario A. The personal consumption expenditures data comes in high. This proves inflation is still running hot, the consumer is still spending despite the pain, and the Federal Reserve has no choice but to stay strict.
And rates stay high?
Exactly. They keep interest rates locked over 5%, and gold stays heavily pressured by that opportunity cost.
And scenario B is the lifeline.
Right. Scenario B is the data comes in lower than expected. Inflation is genuinely cooling off. If that happens, the market will instantly and aggressively price in Federal Reserve rate cuts.
Which changes everything.
It does. If those bond yields drop from 5% down to 4 or 3%, that opportunity cost vanishes and money floods back into gold, we would see a massive upward bounce.
But let's be real with the listener for a second. What are the actual odds of scenario B playing out?
Look, based on the leading indicators, the probability of a miraculously low inflation reading is considered quite small.
Why is the deck stacked against a low reading?
Because energy costs dictate everything. Oil prices have been stubbornly high for months. When oil is high, the cost to deliver every single good to a grocery store or a warehouse goes up, and that bleeds directly into the final consumer price.
That makes sense.
Furthermore, the recent Consumer Price Index and Producer Price Index data both came in hot. The mathematical foundation for a low PCE read just isn't there right now.
Which means the pressure on gold is highly likely to continue. And this is exactly why you have to be so careful when looking at a chart that seems to be bouncing back up.
Yes. Unless we see a massive return of institutional ETF buying, any short-term upward price jumps you see on the screen are incredibly vulnerable.
Right. It's what traders call a dead cat bounce, right? A brief, totally misleading upward spike in price that happens simply because short sellers are cashing out their bets, not because real long-term buyers are returning to the market. It's essentially a trapdoor.
It will look like a recovery, and then the traders will take their quick profits, sell again, and the price will drop right back through the floor.
Okay. We have covered a massive amount of incredibly complex ground here. We've dissected the timeline of the bloodbath, the crushing weight of high treasury yields, the deflation of the geopolitical fear tax, and the looming final boss of the personal consumption expenditures data. Let's distill all of this into concrete, actionable takeaways. How does a regular investor navigate this extreme volatility right now? Let's start with the short-term outlook.
In the short term, you must accept there is a high probability of continued downward pressure. You need to watch the technical floors closely.
Give us the numbers.
For gold, the major support zone is between $4,090 down to $4,050. If it does manage to rally, the resistance ceiling where sellers will likely step back in to push it down is between $4,150 and $4,180.
And what are the specific concrete floors for silver?
Silver's absolute critical floor is $62.
62 flat.
Yes. If it breaks that, the fall could be sharp. If it tries to climb, it will hit a brick wall of resistance at $63.50.
That paints a very turbulent picture for the next few weeks. But what about the macro long-term outlook? Is the multi-year golden bull market completely dead?
Absolutely not. The long-term bull cycle is fully intact. The pressure we are analyzing today from the Federal Reserve and the U.S. dollar is cyclical. It is a few months factor.
Okay, that's reassuring.
Underneath all of this short-term noise, long-term physical demand and central banks actively diversifying away from the U.S. dollar continue to provide a massive, unbreakable foundation for the precious metals market.
So we have a clear mandate to trust the long term, but a very dangerous minefield to walk through in the short term. So if someone is listening to this right now, staring at their trading app, and they are overwhelmingly tempted to drop all their available cash into gold simply because it is $100 cheaper than it was yesterday, what is your exact step-by-step warning to them?
My warning is that impatience will destroy your portfolio. Strict capital management is your only defense here.
Okay.
First, do not assume this current evening pause is the bottom. Second, do not chase the dead cat bounces.
Yeah.
Do not get lured into throwing your money in just because the price takes up $10 on a 1-hour chart.
So how should they deploy capital if they want to buy the dip?
If you decide to buy, you must divide your capital. Buy in smaller parts over multiple periods.
Never go all in.
Never go all in on a single price point when a market is this volatile. Wait for the personal consumption expenditures data to hit the market and show you the true direction of inflation. Most importantly, maintain a strong cash position.
Why is cash so important right now?
Cash gives you the flexibility to react to new data, rather than being trapped inside a falling trade with absolutely no way to average down.
Divide your capital. Let the economic data reveal itself before you commit your heavy artillery. It's about surviving the volatility so you can actually profit from the recovery. That is phenomenal practical advice.
It really is the only mathematical way to survive a market capable of moving $100 in a single morning.
Well, as we wrap up this deep dive, I want to leave you with a final, slightly provocative thought to mull over. We have spent this entire time talking about charts, algorithms, interest rates, and panic selling. But the real story here might actually be the widening, glaring divergence between the two distinct markets.
The paper market versus the physical market.
Exactly that. On one side, you have the paper market, short-term retail traders and algorithms reacting purely to temporary interest rates and 60-day geopolitical band-aids, dumping digital contracts in absolute panic.
Right.
But on the other side, you have the physical market, where central banks and institutional whales are quietly backing up the trucks, taking physical delivery, and locking away thousands of tons of actual metal for the next decade.
It is an incredible contradiction to behavior, truly.
The question you have to ask yourself as an investor is, which market is telling the truth about the future? Is it the panicked day trader dumping contracts at 5 in the morning, or the central bank quietly stacking vaults with physical gold? We really want to know what you think. Do you believe we have finally hit the short-term bottom today, or is gold going to drill right through these support levels when the inflation data hits? Let us know your predictions in the comments below. And as always, please remember to like this video, subscribe to the channel, and turn on those notifications so you never miss our next deep dive. Remember, don't let the fire alarms push you into a panic. Rely on the data. Thank you so much for giving us your time today, and we will see you next time.